Mhm.
All right, connecting. All right, we are live.
Yep.
Seeing more people joining.
Yep.
All right. All right, we'll be starting at, let's give it 2 minutes before, to let people join in. And as you're coming in, we'd like to hear where you're coming from or where you're staying at. Let's see.
We don't have a chat
Oh, is
box,
there a
right?
chat
So
box?
we have Q&A, but we
Oh,
don't have a
that's,
chat box.
we don't have a chat. Okay, right. Okay, so sorry
That's
about that. I
that's
guess we
fine.
won't be able to do it.
I guess people can type in where they are from, I guess,
I'm
in
thinking.
QA.
Yeah,
San Jose.
awesome.
Oh, Chuan.
West
Long
Coast.
time no see. Who else? Come on, people, don't be shy. We have 20 people now.
Yeah, we're gonna start in about, I would say, give it 2 more minutes.
I see a lot of familiar names.
Yeah, definitely lots of familiar names. Hey, Eddie from Hong Kong. Eddie.
Sue from New Jersey. Paul from California. Nice, nice.
We do have great representation from both sides of the coast. Awesome.
And also a different country.
Yes, that's right. All right, so looks like it's getting close to the hour at 5:02. You think maybe we should get started?
Yep.
All right, so let me get my controller right. Okay, so hi everyone. Well, welcome. I would like to thank everyone for joining us tonight. I'm really excited to share a very unique co-investing opportunity that I believe is a great hedge against recession. Our goal for the webinar is to keep it within 1 hour, and we'll do 4 or 5 minutes for the main presentation, and hopefully we have 15 minutes for questions. And we have people from both East and West Coast. Welcome, and in various time zones. There is a lot to go through, and we'll open for Q&A at the end. Please use the Q&A box at the bottom of the screen and fill it in. All right, let's get going. Now, this is our legal housekeeping. First off, we are not an investment advisor and always do your own due diligence. Right? Private equity is illiquid and there's always some degree of risk, which are outlined in the PPM documents. What we have tonight is an overview of the offering. This opportunity is a 506C offering for accredited investor only. If you are a sophisticated investor, you're welcome to listen. We'll provide everyone a recording of this webinar, and we go through the slide too quickly. You can go watch the recording as well. All right, so let me go to the next chart. All right, so this opportunity is like any real estate investment with cash flow and tax benefit. What set this deal apart is the high 21% cash on cash return. Also, the fund can achieve this without using any leverage, which is rare in this market. Obviously, the manager can juice up the return by taking additional leverage, but the deal is already in double digits IRR. I know we have many real estate investors on this call, and myself included, and we can balance out the rest of our portfolio that are leveraged. Lastly, if you're about to experience a large capital gain in 2021, and listen up, this is very consequential. Most real estate deal is not 100% depreciated. If you have land and other fees that are not depreciated in the same capacity. With this deal, 100% of the asset you invested is depreciated. I know we have had keeping it as a suspense to tell you what this asset is. We'll promise we'll tell you everything just a moment. All right, so this is our agenda. All right, we'll first start with an introduction to our company and our team. Then we'll talk about the business environment and our investing philosophy. We also cover why this investment is a recession resistant and how it's inversely correlated to the business cycle. And we'll talk about what we are investing, the business plan, the manager, and the underwriting model. We'll conclude with the risk management and the due diligence process. Hopefully, we should have time to answer your questions to the end. If we run out of time before we finish answering questions, we will follow up with you or make a short video to address them. And for those of you who don't know us, Sharpe Investor is a private equity group. Our focus is to co-invest with passive investor to achieve asymmetrical return with the downside protection. And I'm Henry Yoon from Seattle, and I'm married with 2 kids. I have an engineering background and work as a project manager in a Fortune 500 company. About 9 years ago, I caught the real estate bug and found a company with my partners. Since then, our team has renovated over 50 projects and built 5 single-family homes. We're still managing a rental portfolio, and we're super hosts on Airbnb. And my own experience has taught me that working in a team, especially in real estate, can make a bigger impact and more rewarding than going it alone. Plus, it's more fun. I'm really excited about this project, and thanks everyone for joining the call. Yan, you can take us from here.
Hello, everyone. My name is Yan. As a risk manager at Wall Street, I can easily apply my risk management skills, analytical skills, and portfolio construction technique to real estate investing. Compared to financial market, real estate data is a lot less. And once you found a long-term trend, you can easily apply and write on it. That's why data analytics skill is so powerful tool in real estate investing. Just like most of you, I am a passive investor myself, and I experience a lot of difficulty and struggles as an individual passive investor. After some deep thought, I believe a co-investing model is the solution to solve my own problem and many of you like-minded passive investors. That's why we offer at Sharpe Investor Group a one-stop solution to clear the hurdles in your real estate investing journey. I'm very passionate about sharing what I've learned and thought along the journey. Many of you attended my an hour-long educational webinars on various topics. Below are just some of the webinars I did last year. You can always go to www.sharpeinvestorgroup.com/webinar to watch the videos there. And all these videos to address your struggles as passive investors, and then try to provide you with more perspective. Lastly, I want to mention in my free time, I enjoy running. My marathon record is 3 hours and 35 minutes. What I learned from my marathon training is that first, you need to make a long-term plan. Marathon training takes 4 or 5 months, and then you need to put it on your calendar. Second, you have to be very, very disciplined and show up every day. Also, you need to do risk management to prevent yourself from injury. And lastly, but not least important, is that you have to be very, very patient, because every day you're not seeing the progress, but eventually it will get there. So this is who we are, an exciting technologist and a boring number person. Next. Okay, those are the hurdles that passive investors face. I'm too scared to invest. I don't know anything about investment. I don't have any time to research. I have no deal flows. I don't know how to evaluate deals, or I have too many deals coming my way. There's impossible for me to evaluate all of them. Or after your research, you found out it's quickly oversubscribed, you cannot get in. Lastly, after you did all this work, you found out you ended up with an over-concentrated portfolio. Trust me, I've been there. These are all my struggles. So our goal is to find the solutions to address all these hurdles. Next. At Sharpe Investor Group, we're very keen to provide a one-stop solution to solve all the problems mentioned earlier. If you're too scared to invest, we provide free educational content. We also did extensive research on location, asset class, market cycle. We vetted the sponsors and we sourced the deal flow. We also did independent underwriting and we did it in an efficient way. Finally, we also co-invested with you so that our interest is aligned. Lastly, we try to help you to build a diversified portfolio. So what is this co-investing about? Are we active or passive? So to begin with, let's look at the analogies at the bottom of the page. I believe you do your own tax filing already. So how do you do it? So there's a wide spectrum. On the left-hand side, you can be very active, meaning that you go to IRS website, you download a tax form there, and then you fill out the form without any help of the software. In the middle, you can use TurboTax, or you can hire a CPA to do all this work for you. Or even better, you can hire a tax strategist so that you can optimize your tax planning. So you can always find a position in this wide spectrum. The problem is that depends on your own experience, your expertise, your time, your value, you can pick the right spot for you. There's no right or wrong solution. It's only the one that fits you. And also we want to point out two things. One is that value is what you get. Price is what you pay for, right? So yes, you can do everything by yourself without paying anyone. However, you need to ask yourself, is that the right use of my time? Is it worth it? Can I get a better service by outsourcing to other people? So similarly, this principle can be applied to real estate investing. As passive investors, you can be very, very passive or you can be very active. On the left-hand side, these are the active investors, also known as sponsor or operator. Those are the people who are doing heavy lifting. On the right-hand side are passive investors. So the only thing they do is just provide the capital to the sponsor so that they can implement their business strategy. At the end, both the sponsors and the passive investors benefit from executing the plan. So where do we stand at Sharpe Investor Group? We are in the middle. We call ourselves active passive investors. So what does that mean? So first of all, you see that the white box. So that white box is passive investors. So we only provide capital to the sponsor. We are not doing any actual work on the property itself. So that defines our role, is passive investors. However, if you look inside the white box, basically you can see that Sharpe Investor Group provide a one-stop solution to passive investor in return for a small percentage-based split. This is a very, very important concept because first, a lot of people get confused. They thought we are GP. No, we are not GP because we cannot control the outcome because we are not doing the actual work besides providing the capital. Second thing, we don't charge for asset management fee. We only get paid based on the performance. We don't get paid by how much capital we raise for the sponsor, because we believe if we get paid that way, that will misalign our interest with our investors. So there's no right or wrong. It's just we choose to be paid this way so that we can get aligned. Now, between the white box and the active sponsors, there's also value and price exchange. So you can see that sponsors are very happy to have a co-investing group because now they get a larger paycheck when they are dealing with less investors. So it gives them less burden on the operational side. On our side, we also get what we want. First, when we invest, we can guarantee a spot in that good deal. Second, when we have more and more investors, we can leverage that to negotiate a better term from the sponsor. Next. Okay, so these are some of my thoughts when I started investing in 2020 and 2021. Those are my personal observation. You can listen to it, but please don't take it as an advice, because we are not investment advisor. So what I observe, chart 1. So basically it says too much capital is chasing too few good deals. So this is just an example. The dark blue line is the outstanding US Treasury. So you can see more and more money in this market. However, the light blue shows lower and lower return. So the chart is in reality. I want to tell you that when you invest in something, I want you to set the right expectation of the return. Because of this overflow of capital, your expected return should be going down. On the right-hand side, if you can go to, the next one. On the right-hand side, due to this market uncertainty, if someone tell you, hey, this deal, your return will be X, I would encourage you to ask one more. What's the probability you think that you can achieve that return? Because when the market is uncertain, it's not a point estimate. You need to have multiple estimates. What's the return in base case? What's the return in worst case? Can I live with that, right? So always think in a probability perspective. Next. This chart, I want to say that risk and return are two sides of the same coin. So, so you can see a different asset class. They have different profile in terms of risk and return. You don't always chase the asset that give you the highest return, because that will also bring you a higher risk. And you don't disregard the asset that has lowest return, because by adding that to your portfolio, it may lower the risk of your portfolio. So always think in terms of risk-adjusted return. Next. The last chart, I want to remind yourself, when you think about your portfolio, think about it from a more holistic perspective. So let me give you a concrete example. Let's say you are an employee from high-tech industry, a high-tech company. You have very high income, not just in terms of W-2 income, but also including your company's stock, maybe options. So that gives you a lot of room for appreciation because of the growth potential of your high-tech company. However, that also exposed to the downside risk. So how do you hedge it? You might want to consider adding some assets, some borrowing assets, to stabilize your portfolio. On the contrary, if you have a very stable job and very stable income, but lack of the upside potential, you might want to add some assets to your portfolio to increase the upside potential. So when you think of your portfolio, always think in a holistic view. Next. Okay, so with that, we will start talking about this investment opportunity. But before we start, I have a personal ask. I want you to give us maybe 20 minutes, and then and also clear your glasses. If your glasses is full, then whatever I said, it will just spill over. Instead, we ask you to empty your glasses so that the data I'm about to show you can speak to itself. we don't want any personal opinion. We just want to find out the hard facts. All right, so here's a quote I really like from Neubawa. You know him. He's a data scientist in real estate. So he said that data beats gut feel by a million miles. That's a quote I really like, and you will find out what I mean by that. Now, I want to share my personal experience with this investment. So the first time I heard about this investment opportunity was September last year from a sponsor I follow for a long time. I really like him. He is a deep thinker, an independent thinker. So that was September. I was on a road trip with my friends. So I saw the email and then I immediately shut down to these investment opportunities. Because I have some personal view on this industry, and then I feel like there's no future. When I returned that weekend, his email came in again saying that we are about to close this deal. If you want to invest, please grab the opportunity. Now I become very, very curious because I was thinking to myself, how come such a smart person, a deep thinker, think this is a good opportunity, but I immediately shut down? Is there anything that he sees, but I don't see it? Is it because I have some ignorance or bias that blind me? So I try to give it a couple of hours and listen to his pitch and then do my own research. I'm glad that I did it. So the more I started, I feel like this is peeling an onion and there's so many layers in it. And every time I dig out more data, I found out that this deal is structured in such a delicate way, it protects investors so well. So that's why 4 months later, not only I invested in this deal, I'm also presenting you these opportunities. I think this is the opportunities that investor may want in this uncertain market condition. So let's start.
All right, thank you, Yan. Now here's the big reveal. We are investing in the ATM business. We're investing into a Prestige investment group. Prestige and its affiliated company are the top 5 owner-operator of ATMs, and they plan to add 1,000 ATM across 8 states. Some of them are in the Northeast and some are in the Southeast. The core strategy is to bid on placement contracts for existing ATM and then replace those ATMs with new ATM with optimal technology to generate a cash flow stream. Through the partnership with well-known retailers, they are able to win location contracts with retailers like McDonald's, Walgreens, CVS, etc. This model is not something that a competitor can easily duplicate. Prestige will replace the ATM with new machines with better technology to capitalize the digital advertising. The cash flow is generated by the transaction fee between $2 to $3 per transaction, and it is split between the retailer, the ATM operator, and the investor. The retailers are happy because the ATM brings foot traffic and increased sales. Now, this is a quasi-real estate play because the ATMs are located in attractive locations with strong transaction records. They're replacing existing ATM where the transaction data is readily available. Prestige has access to those transaction data, and because of the sample size, it's very predictable. If you can see an average of 500 transactions per month going back years, it just makes a very compelling business case. And here is a high-level summary. The fund is projecting a 7-year hold period. Our investment fund will pay out 21% cash on cash after paying expenses. The minimum investment is $53,000, and your investment goes into purchasing the ATM. Investor will receive the first distribution 4 months after investment has been made, and then monthly thereafter. We intend to use bonus depreciation to write off 100% of your investment amount in that year. Now, this is not a tax advice, and you want to talk to your accountant, but this is very consequential for your passive losses. if you invest 53,000 and you should anticipate 53,000 of passive loss. If you don't have the gain to offset that, you can carry that loss to future years. Now let us address two narratives the media often talk about or people are likely concerned with. The first question is our society becoming cashless? Now, second question, with technologies like Google Wallet and Apple Pay replace cash and made ATM obsolete, is technology killing ATM? So first, Yan will address the first narrative about cashless society.
Hello again, this is a number person talking. I am here not to present my personal view, but the hard facts. So let's start with the left-hand side. I know it's very small, it's very hard to read, but two messages here. First, you will notice a very nice, consistent increasing trend. So what this chart is about, this is the currency in circulation in US from 1995 to 2019. And in fact, not only it consistently increased after 2009, actually the speed of increase is actually faster. And the last data point, not showing here, but I put it as words, is from July 2020, which was 6 months ago. That currency in circulation actually reached 2 trillion. 2 trillion with 12 zeros, if I count it right. So, okay, so does that not match with your imagination? Because I believe everybody here do not use cash very frequently. However, this is the hard fact that actually the demand for cash is not decreasing. It's actually increasing and increasing consistently. On the right-hand side, we also break it down every year, every month. So what you observe first is that first, it's highly predictable. You see the pattern in every month, it's almost the same every year, except for the yellow line. I know you cannot see it. Yellow line is actually from 2020, which was last year. So it spiked up in February 2020, which exactly when this is better. So which is exactly when COVID started to hit. So what does that tell you? First, I like the stability of the cash. Second, when recession hit, when COVID hits, the demand for cash increased because of the safety demand from people, right? So that's why we call it a recession-resistant play. Next. Okay, so you might have a question. If I don't use cash, my friends around me, they don't use cash, how come there are so many cash flowing around? So who are the people using them? So left-hand side, you can see there's a pie chart. There are three types of people by household. One is called fully banked, meaning that they have access to credit card, bank account, debit card, whatever, right? So those are you and me. However, there are underbanked or unbanked population, which you don't see it. But together, they add up to 30 million. So those are the people who doesn't have bank account, who rely on cash flow, who rely on cash to pay their bill, to pay their lunch, or to buy any service. So that's one fact. If we zoom in to see who are those people, I know that it's too small for you to see, but the characteristic of those population are normally the household less than 40,000 income. And it constitutes almost to 40% of the population. So those are the people underbanked or unbanked. There's also other characteristic of it. What's the education level? What is the race breakdown? So what I want to say is that given that this demographic trend will not change quickly, we can expect the demand for cash will not change. It will last for foreseeable future. Next. Okay, the second type of cash needs is what I call cash by choice. Those are you and me, right? So we don't use cash because we don't have a bank account, right? So we use cash because sometimes it's just convenient, right? So some fun facts, right? So young people use cash more than any other payment instrument. Is it true or false? Surprisingly, this is true. And then the average consumer, okay, so let me give you some data. So young people, so the share of cash use among the age group under 25 years old is highest. It's actually 34%. The next group is above 65 years old. They use cash for 33%. So those are the age group that use cash very frequently. Second thing, the average consumer carries less than $10 in cash. That's not true. On average, consumer carry about $60 in cash. I know for me, if I want to withdraw cash, I always withdraw 100. And the next question is that consumer use debit card for most small value transactions. Is it true or false? It's false. So the small value purchase category, cash is still the king. It made up, so for the purchase lower than $10, they use cash for half of those transactions. For transactions between $10 and $25, cash and debit card use about 33% for each category. On the right-hand side, you will see where cash is heavily used. For example, fast food restaurant, coffee shop, grocery store, convenience store, gas station. Those are the places that people use cash a lot. And I think people can relate. That's what we observe in the city. And those are the locations I want to specify. Those are the locations that Prestige specifically chose. Next. So what about the cashless society we just talked about? This term has been created since 2000. Everybody expecting it will arrive soon. However, in reality, that's not true. So last year, the federal passed a law called Payment Choice Act, basically prohibit retailers from going cashless at federal level. At state level, we see that several states in Northeast, Massachusetts, New Jersey, New York City, and Pennsylvania, they are long time ago, they already passed the law prohibiting retailers doing that. So those are the states that Prestige actually invests heavily in. Next. Okay, so this is an interesting layout, and I also want to the point I want to make is to clear people's conception, like what is competing with what, and can A and B coexist in the same picture? So first, I want to show you the whole framework. The way I think about it, we just address everything on the right. So yeah, different people, they prefer different type of payment method. So first two, they prefer to use cash because they are those underbanked or unbankable people. The third one, like you and me, we would like to use a credit card to pay for the service or goods, right? So we just talk about that. So on the left-hand side, where do you get the money from? Okay, you work and then you get paid, right? So the payment can come in as different forms. It can be ACH payment, directly deposit to your bank account, or some low-income household, they can get the EBT from the government, which, by the way, is growing very, very fast. And then also, some labor workers, they get a check, physical check, or some debit card, right? So between what's in your bank versus how you pay for it to get the cash, we need a conduit, right? So there are different conduit, right? So if you want to get the cash, you can either go to the branch or you can use ATM. So if you go to the branch, then first you have to go there in their business hour. Second, you have to wait in line. So that's why we put a local roll here, and there's an older car there. It drives very, very slow. Or if you don't want to wait in line, you don't want to go at business hour, you can use ATM because it's 24 hours and you don't have to wait. So it's more convenient and more popular. That's why we show this is a highway, and also the car is a sporty car. It drives faster. So a lot of people will think that, oh, but with the credit card, with the Google Pay, Apple Pay, everything will die, right? So, but that's not true, because we just said the need for cash will not die. It will exist for a long time. But we also get that if you are using credit card, you don't need to drive. You just directly fly from point A to point B. But the fact that the plane, the car can both exist, we think this is also true for the whole industry. Cash is needed, ATM is needed, and ATM is competing with the bank branches. While you can use credit card, that's a different route, but they can coexist for a long time. What's actually competing is the mobile app versus the physical credit card. Let's move on to the next one to see who wins the competition. So we just talked about, if you are a cash user, you want to get your cash, you can either go to the branch or you use ATM machine. And clearly the data says that ATM is becoming more and more popular, the blue line, right? So the yellow line says branch is becoming less and less popular, and a lot of them just close. There's a reason. We just explained from customer perspective. From bank perspective, they also welcome this trend because opening a branch is very cost inefficient. And ATM is becoming more and more popular as a cost reduction solution to the bank. So they now brand it as ATM as banking in a box. Next. So just to recap, we want to say first, the need for cash, cash is still using as a primary payment method, especially for underbanked and unbanked population. Second, due to the demographic, we expect the cash by necessity will last for a long time. Lastly, for cash user, ATM won the competition with the branch. So while the payment app are retiring those physical credit cards. So those are the conclusions from the facts. Next.
Hi, thanks, Yan. So I'm going to talk about some of the technology risk, which is, I think, another narrative that people are concerned with, because we all have heard and may have used some new mobile payment technologies like Google Wallet or Apple Pay. And the common perception is that they threaten the future for cash. And I understand, because I personally like using Venmo and Apple Pay because they're so convenient. But I also believe that the risk in near term is not likely. First, there is a demographic play where we focus on unbanked and underbanked population, people with net worth of $600 or less, which makes up about tens of millions of Americans. When we have a low net worth like that, it doesn't make sense to keep a bank account. And there are low balance fees and late fees and all kinds of things that adds up. So that's why so many people have been pushed into the unbanked and underbanked. Second, which is the technology portion component, these technologies do exist for a while. Apple Pay and Venmo, they've been exist for a while, and they're nothing new. But the adoption is very mature. I believe 90% of people in the United States have a cell phone, and they could have the technology connected these apps to the bank account. But that's the whole point. You need a bank account in order to connect these apps and make payments. So if you're underbanked or unbanked, you're using cash. Now, what I've also seen is that the new mobile technologies are likely to take market share from credit card companies and less so for the cash and ATMs. Majority of the demographic using ATMs will continue to use cash regardless of any options. We will see more and more mobile phones used to communicate with ATM, such as on this picture, using contactless technology, such as app-generated codes or NFC like Apple Pay. I also like to make the case that as the technology evolves, ATM machines and technology can coexist. Already we're seeing a rise of a number of Bitcoin ATM in selected markets. In the future, we may also see ATM become just a dispenser of cash. There's no pin pads or no slot to insert your debit or credit card because it is connected to a mobile phone. But we still need cash to make some payments. Yes, there is a risk, but it's a risk that I think I'm willing to take on as risk-adjusted basis because when you see the total return profile, which I think is very compelling. All right, so I believe we presented the case for the ATMs, and hopefully you're convinced that cash is not going away. Now let's talk about the ATM business and the prestige fund. The ATM business is a very, very interesting business. Here's a back of the envelope estimate for the market size. If you take the daily transaction, multiply by $2 to $3 per transaction fee, and multiply by 500,000 ATMs, this market generates a rough estimate of $4 billion of top-line revenue per year. It is clearly a profitable business, but how do you get exposure to this market? Now, there's two primary ways to invest in this market. You can be the mom and pop owners whose main focus is to place the ATM. It can be very lucrative business. People do this. They don't need an investor capital, and the ATM business is not new. And they place ATM in these new locations, and there is much less certainty for the cash flow and much more challenging to scale. The other side of the business is the institutional operators with multiple property location contracts with existing retailers. Yes, there is lower margin, but there's less risk and you can get much better economy of scale. And if all the McDonald's have an ATM in a geographical location, they're usually managed by one company who has a bid for all their contracts. Prestige does have a contract just like that with McDonald's in New York City. All right. Next, we want to talk about why Prestige. They are the top 5 owners and operator of ATMs in the US, and they have ATMs across 45 states. The manager has invested in several funds, and this is their 9th funds. They launched its first ATM funds back in 2012. Since then, they have raised more than $100 million of equity. I know in real estate, we often talk about the size of the deal, including leverage, but we're talking about equity. They raised 100 million of equity and have purchased or managed over 10,000 ATMs. Their first fund started in 2012 and has gone full cycle, and they have never once missed a single cash distribution, even through COVID. One of the members of the senior executive is Jorge Fernandez, who's also a previous executive of Cartronics, which is the largest ATM company in both the US and the world. Also, the management company is certified independent ATM deployer. The banking sector is highly regulated, and if you're going to be the owner-operator, and you need a sponsor bank to do so. A sponsor bank requires you to provide a third-party accountant, financial auditing, and submit all your reporting. Their sponsor bank is MetaBank, and they also is the issuer of the stimulus money via the EBT cards. The sponsoring bank put their license on the line and pretty much says Prestige is under the umbrella and they're in compliance. This is the few cases where regulation is actually working in our favor as an investor.
Okay, this is my expertise. So risk management. Okay, so I want you to think backwards. How can a deal go south, right? So it can come from different aspects. It could be economy downturn that no one can control, or it could be investing with an inexperienced operator, or they are smart people, but they just have misalignment with you, or they become too aggressive, they over leverage. So let's see how we address all these risk factors in this deal. So first, we think this deal is a recession-resistant deal in the following sense. First, we already look at the data, right? So over the past 9 years, it shows that the transaction volume is very, very predictable, stable. And the manager also have 25 to 30% buffer, meaning that even though when something major happened and the transaction volume reduced by 30%, it will not stop them from sending out the distribution that they plan to send out. So that's 30% buffer. Okay, so what happened in COVID? So in March 2020, when COVID, the lockdown first started, they experienced 11% volume reduction. So that 11% is still far from the 25 to 30% built-in buffer. That's why they never miss every single distribution. They pay out on monthly basis. It never missed one single payment. So now it quickly bounced back. Now the level is at almost 100% pre-COVID level. Also, there's some exciting part that we haven't talked about. We will have a dedicated page to talk about digital monetization. So these ATM machine, we are not talking about the old and ugly ATM machine that you can see it from everywhere else. This is a new generation ATM machine with a new look, new technology, new app in store. It can have more use case than you can imagine. So one use case is digital monetization. So that will bring us some revenue. That's the future of the new generation ATM. However, to be conservative, we didn't model that in our underwriting model. So, but in reality, if they do get the digital monetization revenue, they share the 12% with the investors, even though it's not included in our underwriting model. Lastly, we also talked about the unbankable population actually grows during recession. So it's counter cycle. We also talked about the why we chose prestige. So we can skip that. In terms of alignment of the interest, they get compensated after investors get paid. And also remember, in this case, we don't leverage. So that means there's no creditor will take the distribution first. You are the first one to get paid. Then is the prestige, the manager. And there's no leverage, so no worry about over leverage. Now move on to the next. Next page, we can talk about our team, what kind of due diligence we as a whole did. So my coach is also a consultant on this deal. He spent several months conducting due diligence on Prestige and also this offering. So what he did. First, he did an on-site visit to the manager's office to make sure it's a real company. Also visited the ATM across 3 states, and also reviewing the contract, location contract that's signed with all those Fortune 500 retailers that we just showed. Also had multiple due diligence conference call with the key principle of Prestige. We also conduct a lot of independent research. All the data we call in this slide are all from official website like US Treasury or other very serious research organization. Next. Okay, here is the deal. On the right-hand side, you as a passive investor, we together will invest into this Sharpe Investor Group ATM fund. That's the bull here. Then we together invest into Prestige, who hires the ATM management company to manage the day-to-day operation of the ATM. So a couple of things that you want to know how we get paid. So first, we are very proud that we don't take any asset management fee. As I mentioned, that we can't get paid. However, we chose not to because we want to line up with investors. We don't want to bring in investors who might not be suitable for these cases just because we want to bring more capital and then get paid. No, we only want to get paid based on the performance. That's the 90-10 split that we are talking about. Only when this deal performs, then we get paid. If it does not perform, not only we lose our own money, we also don't get paid. So that shows how much aligned we are with your investment and our own investment as well. There is a one-time setup fee, $1,000. That's because we pay upfront for all the legal fees, marketing, and then research to get the data. That's the setup fee. That's one time. Next. I will quickly go over this underwriting model. Don't worry, we will send out the PowerPoint. You can read it, but just a couple of things to highlight. So you don't have to read all the years because they are all the same. Just read the first year. So the assumption is that, okay, the minimum investment is $53,000. And then every month, we, at the fund level, we received $1,092 from Prestige. Then deducting some expense at our fund level, and then 90% goes to you, 10% goes to the manager. We also, to be very conservative, we assume that we only have 10 investors. What does that mean? That means whatever the expense is only shared by 10 people. So that way, we basically inflated the average cost bear by each investors. When we have more and more investors, let's say 50 investors, each person actually bear less expense. So we want to be conservative. That's why here we only show 21% return. But in reality, it could be different because every model is just projection, right? We want to be more conservative than more aggressive. So the first part is the income. As I mentioned, at the fund level, every month we receive $1,092 times 12 months. You get $13,000 per year. We are not taking into account the revenue from the marketing piece. We put zero there, but you can have positive income from that one. Now the expense part. So the expense covers bookkeeping, tax, and then also tax filing for the company. And also when we grow bigger, we want to have the investor portal. So we budget it, but at the beginning, we're not going to spend that money. So after take out the expense, the left cash flow is highlighted in the bold part. So it's $11,200. However, it's $12,500. However, as I mentioned, the biggest bonus for this one is that in year one, you get 100% bonus depreciation. So imagine if your tax bracket is 40%, that can actually give you a lot of benefit. So after taking into account the depreciation, now your return becomes $30,000. So we always present two numbers. One is without bonus depreciation, that's 21% cash on cash. With the bonus depreciation, the first year, it gives you almost 57%. And in terms of IRR, with the bonus depreciation, that gives you 23%, which is the way that most of the real estate deal calculate their IRR. So next.
Thank you, Yan. So now we're in the bonus sections. We're going to talk about the potential upside on this deal. And to be conservative, they're not included in the underwriting. First, there is the digital media. These are the video screens on top of the ATM that you can show weather and other news update at the bottom of the screen. It will stream advertising on the top part of the screen. That's why retailer really love this, over the older ATM machines. Next is bank branding. The operator can charge regional or national banks between $50 to $200 a month for branding in strategic locations. This picture here is a Citibank ATM that was taken at a grocery store, and that ATM is actually owned by Prestige. Now, the ATM can also sell electronic gift cards, and the operator can load custom hardware software into the ATM machine so they can allow them to select gift cards. As for the digital donations, the user can donate to their favorite charity using these ATMs. The charity will pay a small percentage of that donation back to the ATM operator. Now, the ATM operator will share 12% of the revenue to the investors, but these are not included in the cash flow stream in the pro forma. The reason that is, right, because the new ATM already equipped it with these new technology, and it's great if they can turn it on, but we want to be conservative and want to use just the transaction volume, just the $2 to $3 transaction fee to make up for the return, because that's much more predictable and has a recession-resistant component to it. So what are the next steps? We have already done our analysis and due diligence. Today is March 8th, and we have completed this webinar, or about to. And our target date for the funding is March 15th, which is next Monday. Between now and funding, we need all the legal documents to be signed and wires received. So if this deal interests you and you want to invest, the first step is to submit your soft commitment by filling out the exit poll, and I will launch up when we get to the FAQ section. The second step is we will send please send us your verbal commitment by the 10th. And the third is to go through a third-party verification website like verifyinvestor.com or other vendors to confirm your investor accreditation status. Now, the fourth step is to review the legal documents and ask any questions. Once it's completed, we can verify your status. We will send you the legal documents via DocuSign. Once that's approved, please wait for the wiring instructions, and you can wire the fund into the account. Right.
Lastly, we want to thank you for giving us the opportunity to present the data to you. I know this is a lot of information, and to be honest, when I first looked at the data, I couldn't believe it. I couldn't reconcile with my own feeling. But that's the beauty of it, right? So you have to be open-minded, let the opportunity to present itself to you instead of being closed-minded and then only look at the domains that you already know. I feel like in 2021, a lot of sectors may experience reshuffling. A lot of opportunity may present themselves. What we need to do is just be open-minded and let the opportunity shows up. So as a closing mark, as I always put it at the signature of my weekly newsletter, educational newsletter, we want you to invest with confidence. We provide you all the knowledge, all the details you need to know to invest with confidence. We also want you to invest with the people that you trust. We hope today is a showcase that what we are capable of doing by doing all kinds of independent research. We are not just describing how great this deal is. We questioned it from a passive investor perspective. We do all this analysis. We attack ourselves by challenging each other what kind of questions that the passive investors will ask. We provide you the primer of ATM and banking and cash. Hopefully that can explain why a seemingly obsolete technology can make so much money. We hope that can clear some of your questions. If not, you are more than welcome to contact us to ask more questions. But lastly, we want to mention that because of this short window, you do have, if you're interested, please do let us know at the exit poll, and then also follow the steps that's outlined from previous page. And lastly, you will receive a record video and also this PowerPoint, hopefully tomorrow, and then also a link to all the legal documents so that you can review it and get prepared.
All right, well, thank you. So now we're going to the FAQ. I know we're already at the hour, so we're trying to answer all the questions we have, and we also put out the frequently asked question up here so you can read it. And I'm going to go through the question, and also at the same time, I'm going to put up the poll. So this is where we can take your soft commit. Let's see, I'm going to launch that poll, so you'll be getting that on your screen. So let's go through some of the questions, all right?
Before you go there, I just want to say this exit poll, including the verbal commitment by March 10th, it's just verbal commitment. It doesn't mean that you have to follow through. So we just want to collect the information, how much interest is there. You can change your mind later on, but if you do want to, please commit, verbally commit before March 10th, because we need to send that message to our sponsor.
Okay. All right. So ready for questions? Okay. The first question from Jin Lee. Well, thank you for attending. What is the unit economics of each ATM investment for Prestige? I think maybe we want to break down the numbers. What is their plan to invest in new ATM each year?
Right. So maybe we can break down the questions. What is the unit economics of each unit? So when economists, what exactly do you mean? I'm not 100% sure, but what is this plan? So this fund, they are planning to raise 100 million total capital. Their plan is to purchase 1,000 to 2,500-ish ATM to put in high traffic location in most of northeast states and also southeast states. So those are their plans for this fund. So how do they select the location? So they only select the location with proven volume history. So they don't bet on the traffic. They only look at the data. And if the historical volume is high, then they will get into the contract. So they do that for all their locations. Almost 99%, they have the historical volume data.
Oops, sorry, go ahead. You were saying.
Right. So trying to understand the unit economies. So basically at fund level, at our Sharpe investor group ATM fund level, if I can you go back to the underwriting page? I know that it's very small and we didn't have time to go through all the numbers. So for example, as a passive investor, the smallest amount that you can contribute is 53,000. So that basically can get you to roughly 3 to 4 ATM plus the location contract associated with that, right? So, okay, then with that 53,000 investment, every month after the fourth month, because it takes time for them to buy the ATM and then put it in the place, right? So let's ignore that part. So once they start distributing the money, you get a cash flow every single month for all the 84 months. Every month you get, so at the fund level, we get $1,092, but we subtract the expense to the third party. We're not paying ourselves, only pay for the accountant, things like that. And then we do the 90-10 split. So that will give you to the 21% cash on cash to be conservative. So yeah, when you get the slide, you can research this underwriting model. Yep.
Yeah, also let us know if we didn't answer, or maybe you can clarify the question regarding the unit economics.
Yep.
But maybe if one thing that might help you in the underwriting model from Prestige, they're basically using 492 transactions per machine per month. These are very high traffic retailers, McDonald's, Walmart, Walgreens, and the like. So they're definitely with lot. Actually, they're also buying these with transaction records prior to purchasing, so they have all this data available. So hopefully
Right.
that helped answer that question. Oh, and the transaction fee is between $2 to $3. I think the underwriting they use $2.50.
Right. Also, I want to mention, if you remember, when we do the back of envelope calculation for the whole industry, we use the industry average transaction volume that says an ATM machine every day is 6 to 8 transaction. So if you take it as 7, then multiply by 30 days, you get 210. That's not what Prestige has, because they specifically chose high traffic location. Every month, averagely speaking, they have 492 transaction volume. So it's more than double of the industry average. That's what I want to point out.
Okay.
Okay,
I think
let's move on.
we might have to speed up a little bit. Okay, so
Yep.
next question from Wu Jay. I think I'll take this one. Is the bonus depreciation only for real estate professionals? If you are a real estate professional, you're in luck because you can offset your active income. But if you're not, just say you're not, but if you have any kind of rental income as basically passive activity income, those things can be offset. But if you have any left over, you can carry it over for future months. So in some future years, when you decided to sell your rental, then you can use that to offset your income as well. So hopefully that answered the question. It's definitely more benefit to real estate professionals, but even if you're not, you can still use that to offset any passive income.
Yep.
Okay.
Another question from Mary asked me, my previous investment, do I receive the expected cash flow? I said yes, just like a clock, right?
Like that.
Yep.
Okay.
Mhm.
So question to you, maybe I think Yan, you be that one. Peter, hi Peter. How do you connect with Prestige? Also, Prestige has raised $100 million. Why do they still need help raising plus minus 500K?
So I would take this one. We connect with Prestige because I personally invest in this deal, right? And second, as I mentioned, they constantly raising capital because they need those capital to purchase new generation machine to place in those strategic location so that they can gain the market shares, right? So speed is key to their success. And then also those new generation ATM, that's the future of ATM, not just borrowing like a dispersion of the cash, but also some interesting potential that Henry just talked about. Right. So why do they need to raise 500K? Because they're not just relying on themselves. They have limited capacity, right? So we have access to a different type of investors. So that's how we can help. As I said, a lot of times there's a wide spectrum. Everybody can find their unique position by offering their value. Yeah.
Yeah, I also want to clarify on that. I think we're Prestige is not raising 500K. We are, I mean, as a minimum, we want to raise 500K. They're actually raising, I think, $100 million. And they raised $100 million from the past since 2012. So that has accumulated, but they're actually launching a bigger fund. So that they're not just raising 500K. That's just our internal goal as a minimum, is to have these our expenses cover. So I think that's a question. All right, so let's go to Wu Jay. Will the distribution start this year? What quarter?
So this is after fourth month of your investment, then they will start distributing cash.
Yep.
Quick question on the ATM model.
Just curious, how does an unbanked person use ATM? I would assume you would need a debit card to make transaction on ATM.
This is a very good question. So we mentioned, if you remember that chart on the left-hand side, there's a slash EBT. This is actually growing very, very fast. A lot of people, the low-income people, the government using EBT card. It's called electronic benefit transferring system, something like that. It's a physical card, and those EBT card, you can withdraw cash using the ATM machine. Actually, the data shows that more and more people actually use the ATM to convert the balance in the EBT card to withdraw cash and then pay for grocery or whatever.
Yeah, you could. So this first round, the second round of the CARE Act of stimulus check, my dad actually got an EBT card, even though he does have a bank account, but he gets it too. So for Unbanked, they don't have a bank account, and that's how they sometimes getting paid. And also they can actually, some of the employers might also be paying them using kind of prepaid card, so they can use at these sites. Okay, so next question, what is the risk related to this industry? From Eddie.
Yeah, of course. So for every single investment, there's no crystal ball, right? So it's all projection. So first, economy environment definitely will have an impact. Second, the consumer behavior pattern change will also have an impact to this one, right? So what if all of a sudden people stop using cash, right? Or maybe there's some unknown technology that can help people to get cash without going through the ATM. I can't think of any, but it doesn't mean that in the next 7 years it won't affect. But what I will tell you is that, yes, just like I said, every model is wrong, but some of them are useful, right? So what I use as my judgment call is that first, you look at how many populations are underbanked or unbanked. Then you ask yourself, how long can this last? The reason I show that most of the low-income people, they are underbanked or unbanked, and most of the like minority, Black or what's the other ethics showing the table, they most of them, they are underbanked or unbanked. So unless you envision that inequality change dramatically, otherwise, I think the trend will last for a while. So that's my expectation.
Thanks, Jan. Yeah, okay. So I think there's a question from Anonymous and Tanny. Is there a way to pull initial capital before 7 years? So let me answer that. So this investment is illiquid. So if you're looking to take the money before 7 years, we don't recommend you to invest in this investment. However, I want to say that this deal, because it returns 20% of your cash every year, so actually before 5 years, actually 4.7 years, you would have all your capital back. So you do have a lot of your capital each year getting back, and you can reinvest that capital into another, maybe another tax benefit and other investments. So hopefully that answered the question.
And I also, sorry, I just want to add one point. And also, because the fact that you are getting cash flow every month, so that also reduces reinvestment risk. Reinvestment risk meaning that, for example, if you invest in a multifamily deal, the distribution of your cash flow is that, for example, if they sell at the end of year 5, so you get small cash flow in year 1 all the way to year 5. And then all of a sudden, you get the huge cash flow at the end of year 5 if they sell, right? So that exposes you to a term called reinvestment risk, meaning that with such an amount at the end of the deal, so first of all, you don't know whether at that time you can sell at a high price. Second, even if you sell at a high price, can you find another opportunity that with similar return that you can reinvest? If not, then your cash just sitting there, not generating any return. This deal, with all the cash flow coming back to you every month, you can always use the cash flow to reinvest into other opportunities if the opportunity present themselves, right? So now you basically distributed your reinvestment risk along the course of 7 years. Does it make sense?
Okay, so let's keep going. So next question: when the fund manager replaces ATMs, do they replace their own old ATMs, or do they have to first purchase the old ATM location and then replace?
So I will take this. So basically, the model it works is that they go to some Walgreens store, for example. Those Walgreens store already have the old generation of the ATM. So those are from other sponsors, or maybe they purchased a long time ago. So Prestige come in, they offer them, hey, I can bring you the new technology, new version of the ATM, and we can share the profit. So then if they agree, they sign the contract, and then they just upgrade it to the new machine. So they are not replacing their old ATM machine. Actually, they came in to sign the new allocation, new address contract with store owner.
Yeah, and these contracts usually have a set amount of time, so maybe 7 years. So after 7 years, they have to renegotiate a new contract.
Exactly.
Question from Mary. Hi, Mary. So the return set amounts, do they fluctuate depend on how the asset perform?
I would say that at the fund level, we should expect very stable cash flow from Prestige. However, on our side, one thing that we think that at the beginning, it might fluctuate a little bit because more investors coming in, everybody can bear less and less expense, but eventually it will be stabilized.
Yeah, we assume it will be really flat, pretty much because of the built-in margin from the Prestige fund. They're really high margin, so they're able to afford
30%.
pretty very so like even in COVID, there was no change in how the fund performed. So yeah, it should be pretty steady. So it is time, almost like 17 minutes past the clock hour. So I think we can follow up with some of the remaining questions. Right now, I just want to say thank you very much, and I know your time is valuable. And
I think I have 3 more. I can quickly go over. Can I use the depreciation to offset the passive income I received from this deal? What's the maximum? Yeah, I can defer the depreciation. So the depreciation part, you will get it in year 1. So they issue us a K1, then we issue a K1 to you. So the earlier the better, because bonus depreciation is going away soon. So take it when you have the chance. Okay. The investors. Wait, hold on. The investors in your group wire money to the account you set up. Yes, we will set up an account just for this SPV. SPV is special purpose vehicle just for this deal, not to our personal account for sure. Okay. How is the crime rate impact the ATM machine business? I have seen news about, yes, that's a very good question, by the way. So, okay, yes. So as an ATM manager, they do buy insurance. So first of all, these new generation of ATM are very, very safe. They have a built-in vault in this machine. So it's very hard to break. Second, even though someone cannot break it, there's some historical event that they basically take the whole machine, not this machine, but for the industry, historical, it happened, still the whole machine. But they have the insurance. Insurance will cover that. What happens if Prestige misses distribution? How does it affect your fund structure? Right. If Prestige doesn't pay, so I would say this. So first of all, the ATM manager, which kind of you can imagine, this is the property manager for Prestige. If they miss the payment, Prestige will call it default. So they will take over the ATM and also the location contract so that they can actually look for another property manager, if you will, to execute this plan. And it should not affect their distribution to us. However, you're asking, what if Prestige also missed the distribution? So first of all, in the past 9 years, it never happened, even in COVID. So we don't know whether it will happen. But yes, to your second question, if they don't pay us, there's nothing we can pay you. Right.
So I think that's the
Okay.
last of the questions. So,
Yes.
right. So thank you very much. Any lasting thought?
Right. So please do enter your verbal commitment by March 10th. Even better if you can do it at the essay poll. Thank you very much for spending an hour and 20 minutes with us. We appreciate so much.
Yes. Thank you. Have a good night. Appreciate everyone.
Thank you. Bye.
Bye.